Welcome back to another video here on Financial Friends. Today we have another episode of the Dividend Journey for you. If you are not familiar with the Dividend Journey, hit the subscribe button, subscribe to Financial Friends, that way you can come to know it. But it is a weekly series where I take a investment portfolio that is focused on dividends. I invest in that portfolio and I bring back the information that I've gathered, different stories, educational points to you while also updating you on the portfolio. So that's what we have today. We're going to be discussing diversification, why you should diversify, if you can over-diversify, why I hold the stocks that I hold in my portfolio for a particular reason, and why I don't just use some form of automated software that does it for me. So let's go ahead and dive into why diversification matters and of course what it is. So at its most basic layman term, diversification is a way, and I'll highlight the sentence, to balance risk and reward in your investment portfolio by diversifying your assets. Now, what does diversifying actually mean? Fidelity outlines these kind of four components of a diversified portfolio. They have domestic stocks, bonds, short-term investments, and international stocks. Now, you can also diversify using sector funds or commodity-focused funds, real estate funds, asset allocation funds. There's all different types of methods to diversification, and I kind of want to highlight this before we dive into the video because, of course, you're watching this video on YouTube, which means you might be watching other people's videos on YouTube, which means you could get the wrong idea here. So let's take a look at domestic stocks. I am extremely well diversified among domestic stocks, but I am not well diversified in this particular Dividend Journey portfolio among short-term investments, international companies or stocks, and bonds. I actually own none of those. I also own no sector funds, but I am diversified among sectors. I own no commodity funds whatsoever. I do have allocation to real estate, but only through one company. And I don't have any asset allocation funds in this particular portfolio, but I do own bonds indirectly through an asset allocation portfolio. I do have additional real estate exposure. I do own a couple of kind of sector funds, if you will. I have allocation to all these, but not in my particular portfolio. So on social media, on YouTube, wherever you're getting your information from, make sure you don't take everything literally. Take it all with a grain of salt because I own a ton of assets outside this portfolio and I am well diversified among my entire stock portfolio, but I am only really well diversified among US-based companies in this particular portfolio. Now, diving further into diversification, my little tangent there, we have this type of diversification, the conservative, balanced growth or aggressive growth kind of outlined here by Fidelity. Now, the point I want to get across here is this. With more risk comes more reward. More risk means being less diversified, at least in terms of the diversification video that we have going on here. So conservative, balanced growth or aggressive growth, obviously 60% of the aggressive growth portfolio being made up of the United States. It has the highest annual average return. It has the highest 12-month return. It has the lowest 12-month return as well. Again, with more risk comes more reward. And being very conservative is the exact opposite. With less risk, less reward. Take less risk, you have less room for upside. The best 12-month return there being 31.06%, but the worst 12-month return being negative 17.67. That's the lowest, with the highest being 60. So take that for what it is worth. Now, the question that you might be sitting there thinking, saying, okay, well, I'll just buy a lot of stocks. Just buy a bunch of different stocks all over the place. And no. Because that would be diversification. What diversification is, or actually over-diversification, means owning too much of something in one particular area, holding something you don't understand, using managers upon managers upon managers, or owning too many individual stocks as a whole. So let's dive into each of those. The first thing here is owning too many similar funds. What does that mean? It means if you're owning an S&P 500 fund in one portfolio and a total US market portfolio or ETF in another portfolio, you might actually be overlapping the type of strategy. The top 500 companies is also going to be held within the total market portfolio. So your overlap is going to be pretty vast there. 500 companies among the, 4 or 2,000, whatever that number ends up being. But if it's a market cap weighted portfolio, you might be extremely exposed to big, large tech companies like Google, Apple, not Meta really anymore, but Meta in its past, maybe companies like JP Morgan or Visa, these really big market cap companies that are then weighted towards the top of these. And owning a lot of similar funds means you have a lot of Apple and a lot of Google in your portfolio. Now, you can also overuse multi-manager products. This isn't so particular to us, but basically touching on it from a very high level, you might have a financial advisor who is telling you what to invest in. You might have an investment advisor who's telling you what to invest in, while the financial advisor is telling you if your investment advisor is doing his job or her job properly. You might also be using ETFs to invest in through your investment manager, which means someone might be actively managing the ETF while they're managing your investments, and your financial advisor is judging your whole financial portfolio. This kind of over-diversification is not necessarily what you need. Now, moving past that, holding too many individual stocks. This could be a great thing, but it's going to lead to the next problem and create another one. You might begin to hold assets you don't understand. That, of course, is never a good thing because you don't know what to look for, you don't know how to manage it. But also, if you're holding too many individual stocks and you are actually doing the work to understand each of those products, you now have so much work for yourself when you really don't need it, and you could probably just be using an ETF to do that instead. Now, moving past over-diversification and diving into why I hold the amount of each company that I do. So let's hop over to my diversification tab here, and we'll take a look at my portfolio and the diversification that I currently hold. I'd like to use this holding breakdown because that's how I like to look at my portfolio. I have very particular allocations that I would like to have within each specific ETF or stock. I want to have 40% SCHD. I'm at 38.93, so I'm about there. I would love to have 10% O, or Realty Income Corp, and I have 9.38%. I'd like to have 10% FISROX, and I'm at about 8.94%, which is a little low. I need to make a little bit more of an investment within that mutual fund or index fund. And then I want to have a 5.7% allocation to each of my individual companies, meaning I'm overweight in John Deere, I'm overweight in Procter & Gamble, I'm overweight in Hershey, I'm overweight in Apple, I'm overweight in J&J, and I'm overweight in Waste Management and underweight in 3M. Now, why do I have each of these particular investments, and why do I want to hold them with that particular allocation? Now, I want to benefit from these individual stocks. I want to make sure that I place a bet on very particular companies that I think will do well in the future. And so I have diversified my risk among the bets that I think are going to be beneficial. Companies like Procter & Gamble, John Deere, Hershey, these are long-term buy and hold, dividend-paying, income-producing assets that I want to own into my 50s, into my 60s. So I'm placing an individual bet on these companies. Now, for the rest of the market, I might not understand those companies company by company. So I'll use SCHD for that. It gives me broad exposure to high growth, dividend growth assets. Plain and simple. I buy into the fund, it continues to do well, hopefully over the long term. The dividends continue to grow from the individual companies that are being held within that ETF, and the dividend for SCHD itself grows, and I get paid that, and I compound that position. Now, Realty Income, that is a diversified asset in and among itself. They own a ton of different real estate, they lease out to a ton of different places, a ton of different businesses, and I feel comfortable placing my money in there as a real estate play. I also own VNQ, which is Vanguard's Real Estate Exposure ETF. I own that in a different portfolio, but for this portfolio, I like O as it's a higher dividend paying asset. And FISROX is kind of my 10% cash pile in an index fund that tracks the entire United States market. And if I ever needed to draw on some cash or pull some cash to make other investments, because this is a Roth IRA, I can do that tax-free. I can move those funds around. I can, get access to those funds if I really needed to, considering, with Roth IRAs, you can withdraw your contributions. There's other penalties and things like that, but that's the idea behind my particular assets. I want to make sure among my individual bets, I'm well diversified, but the majority of my portfolio is held in very passive investments that will continue to grow over a very long period of time. Now, can my portfolio ever be perfect? Can the exact amount of diversification ever become perfect? No. Honestly, my 5.7% allocations, those are not even perfect because it really doesn't add up to perfectly 100% the way I have to divide things out. Those 5.7% allocations to the individual companies, those will get wonky as I begin to add new companies, which will be lower. But the purpose of this is to just have a general idea of the direction I want to move. If one particular asset severely drops in value and the investment thesis behind that position hasn't changed, I can shove a lot more money into that position. Now, you might be thinking, why don't you just use M1 Finance? They've created pies for this exact reason, where you just place money into the platform and it does it for you. And the simple answer is this. I went over to Fidelity. That's where this portfolio that I'm showing you here with the dividend tracker, link down below if you're interested, that's where that portfolio is held. I felt comfortable putting that there. One, I got a free $100. It was an incentive to create an account there with the minimum investment amount. I did it. I got a free $100. Cool. The second reason is because I didn't have any legacy platforms at the time, meaning I used SoFi and I used Public. And M1 Finance, I think, was created in 2015 and is like a newer kind of robo-advisor attempt. I wanted to have a legacy portfolio. I wanted to have something with a Charles Schwab or a Fidelity just because it feels comforting to have some funds at a company that has been around literally forever, just in case. You never know. And number 3 was, while this is a long-term buy and hold portfolio, I'm going to have it for a really, really long time. Again, going back to that legacy point, but I want to make sure that I have complete and utter flexibility with this portfolio just in case. I want to make sure I have access to it and that I have the ability to move funds around in any which way that I please at any given time. Not to mention, I'm relatively in touch with it. It's a whole YouTube series I'm creating around it. So while passively investing in some form of a portfolio would be really easy, I want to be able to actively manage this just in case. And the idea and the thesis behind the diversification that I do have is very passive. Buy the lowest weighted, get back to that weight, and that's it. There's no, this stock fell and it's this price and I'm going to buy in now and sell it. No, there's no timing, just buying. So, I know this was a long one. Thank you very much for sticking through it. If you did learn anything or found any value in this video, go ahead and comment down below what you found valuable. Leave a like on this video, and if you made it this far, comment, follow me on Twitter, because you should. I'm posting there a lot more than I used to. I'm very active, and I'm discussing the Dividend Journey portfolio over there as well. So thank you very much for watching this video. Go ahead and leave a like, and I'll see you all in the next one. Take care.